Hi, I'm Jeff Ginter with Real Progressives. Thanks for joining us every Monday for MMT Mondays, where we rebroadcast talks and lectures and interviews from actual PhD economic experts, people who really know what they're talking about, people who have information that we all desperately need to get a good grasp of, some type of command over, so that we, the people, can rise up and demand of our elected officials a better life, a better quality of life, because they have been keeping it from us for the better part of 4 decades, telling us that these things are unaffordable, telling us that our taxes are going to have to go up dollar for dollar for all the things that we claim that we want. None of this is true. None of it. The role of taxation is drastically misunderstood, dangerously misunderstood in this country. The role of the federal government is underutilized and woefully misunderstood in this country. So we have to start waking up so that we can actually have tools at our disposal to be able to go to our elected officials with and say that we see the bullshit. It's not just that we sense the bullshit, we see it. We see it, we know it, and we're not accepting it anymore. So you are for the people or you're for the oligarchs. I don't care which choice you make, but make your choice, and we'll see it when we hear you speak. And if you're for the oligarchs, goodbye, thank you, ding, you're gone. So tonight, we're showing a presentation from Professor Scott Fullwiler. And I have to apologize, I only took his specific presentation. It's about 50 minutes. It's actually part of a much longer debate and a little bit of back and forth with him and Tim Canova. But tonight, please enjoy Scott Fullwiler discussing buffer stocks. Thanks very much. I'll talk to you soon.
Let's see. So I don't know if Tim can hear me, but I thought his presentation was fantastic, and there's a number of things I'm going to say that are right up along the same lines as some of the points he made. Okay, so as you can see, my presentation is called 5 Buffer Stocks for Macroeconomic Policy. The point here is to look a bit differently at the macroeconomic policy mix from the perspective, obviously, of what I'm going to call buffer stocks. Some of these are generally known, but I think, again, it's a bit different than the traditional view that we have of looking at fiscal policy and monetary policy in their relative domains. Disclaimer right off the bat. I'm not talking about the entire scope of macroeconomic policy for sure. So, and there's more buffer stocks that we could talk about than this. So I'm just kind of hitting a few parts of it that I think are important. Okay, so for starters, what's a buffer stock? Well, in financial markets in particular, we have buffer stocks all over the place because we have dealer markets where dealers hold a bit of an inventory of whatever it is. Perhaps it's treasuries, as in the primary dealers, and they set a price that they're going to sell at, and they allow quantity to fluctuate. And then they'll, in case of dealers, they'll move the price up and down based on how their inventory is moving. The way that I'm using buffer stock here is a situation where there's a price set. In most cases, there's a price being set, and the quantity is being allowed to fluctuate. Okay, that's the basic point that I'm raising here. Okay, so our first buffer stock, currency. So prior to early in the 20th century, we would have frequent financial disruptions in our system, and excuse me, they would carry over into larger crises, in part because of the scarcity of currency. That people would go to their banks to pull out the currency, and eventually banks wouldn't have the currency to give them. And so what we would see is the banks get together in their private clearinghouses and offer clearinghouse certificates that people could then use after the crisis to come and get their money out of the bank. And then they would end up, the certificates would end up circulating a bit as money, but it generally would not clear at par. This would tend to put a floor under the crisis, but it didn't stop the crisis from happening in the first place. So when we get the Federal Reserve, one of the things the Fed is charged with right off the bat is providing an elastic supply of currency, basically allowing the quantity of currency to float based on the needs of the economy, of the private sector. And so they set a price. The price is par value. So if you take your currency to a bank, you can have deposits for $1, $1 of currency for $1 deposits, and vice versa. A bank that wants to get rid of some of its vault cash, it's got too much, can sell that to the Fed and get reserve balances, $1 for $1, and vice versa. If they want currency, they can buy that with reserve balances, $1 for $1. So this works so well that we don't even think about it. That the currency growth fluctuates considerably. It generally trends upward. But there are points in time where it goes up considerably. And again, it's working so well that we don't even think about the significance of it. You can see there Y2K period, the growth was over 30%. And then after Y2K calmed down, the currency growth went negative for a considerable time as people were getting rid of the currency as the scare sort of went away. Currency growth has a seasonal fluctuation. It's got an annual fluctuation. It's got a monthly fluctuation. And again, this process goes off without a hitch. So one of the problems that we have is that because it works so well, we forget about how it actually works, that it's a buffer stock. We have a number of economists that think that currency could be a hot potato in our economy, that we could have a hot potato effect, that we could end up having too much currency, and we would get the economy overstimulated, the excess money balance story, and so forth. So in fact, though, if we did have too much currency, and that's sort of signified by the guy there on the right, holding a hot potato, we'd go to the bank, we'd get deposits, dollar per dollar. The bank would, if it decided it had too much currency, it would go to the Fed, take its currency back, and get reserve balances. If we had too many reserve balances, that's going to be my next buffer stock. So that the federal funds rate falls, the Fed would buy back the reserves by selling a Treasury. Okay, so the hot potato effect stops rather quickly. There is no hot potato effect in currency. It's a buffer stock. Okay. So the first two are things that are already working fairly well, but we often don't understand them. The second one's settlement balances. So in our economy, when people send payments to each other, frequently the bank for the sender and the bank for the one receiving the payment settle the transaction through their reserve accounts at the Federal Reserve. Okay, this is a process that, as I'll show in the next slide, is very significant in dollar terms. So you look at just payments being settled by FedWire, which is the Fed's main settlement service, using these reserve balances. 2011, it averaged $2.6 trillion a day. Okay, so if you look at GDP now, annual GDP in the U.S. being about 15 trillion, then about 6 business days, you have enough payments being settled in dollar value, for a year's worth of GDP. So again, the Fed was charged. One of the main things the Fed is charged with is making sure that the payment system operates smoothly, because you can see there, if you have about 17% of GDP being settled each day with settlement balances, you have to make sure that process works smoothly. A lot of those payments are being settled with that 2.6 trillion, or that make up that 2.6 trillion, are the netted values of an even larger amount of dollar value of payments that were cleared on private clearinghouses. So one of my favorite speeches by a Fed president here, Jeffrey Lacker of the Bank of Richmond, Federal Reserve Bank of Richmond, back in 2006, he writes there in yellow, if the fundamental core of central banking consists of interbank deposit services, then the fundamental core of central bank policy consists of all the terms and conditions under which those deposit services are offered. So that's interesting. The fundamental core of central banking is managing the interbank payment system, right? And so they have to protect the payment system because it's crucial to the day-to-day functioning of the economy. So then he goes in and starts talking about the pricing terms because it has to be a buffer stock. You have to have the quantity of settlement balances as a buffer stock for this system to function. Okay, so one of the things the Fed does is they allow overdrafts, banks to take overdrafts, basically loans within the day. And this has changed a bit in the last few years as the quantity of reserve balances has increased significantly, as we were talking about with Tim. But you can see there by 2008, there was a point in the day where on average the Fed would be offering about $180 billion in credit to banks. And then banks would generally settle this debt by the end of the day. The Fed tries to tell the banks to get all of this off its balance sheet by the end of the day. We'll talk about that in a second. And every minute of the day, on average, the Fed was providing about $70 billion in overdrafts to banks. So what we have here is a situation where banks have a certain amount of payments to settle, and so they have a very what we call inelastic demand for these reserve balances at the quantity they need to settle. Now again, the Fed tells the banks to get all this off its balance sheet, and so what you see is the quantity of reserve balances that banks want to hold by the end of the day overnight, which is largely a measure of their uncertainty of being able to settle their overdrafts with the Fed. And it would have a fairly stable over time, although it would fluctuate from day to day. It would be a fairly stable quantity, somewhere in the neighborhood of $15 billion, $20 billion. And the Fed came to understand that if they didn't get the quantity out there that banks wanted on that day, that there could be significant fluctuations in the interbank, in the federal funds rate, and that would carry over into money markets and so forth. So here's a nice example too. The September 11th, 2001 attacks, you can see there September 10th, September 11th, banks are holding about $13 billion. And then as the attacks hit sort of the core of the payment system, you can see that overnight banks now wanted to hold all of a sudden $44, $104, $121 billion, and then after a few days it tapered off. And so we have a system where there's a buffer stock where the Fed says, here's the price if you want to borrow them, and then make sure it puts them enough out there for overnight purposes as well at the price it's setting, namely the federal funds rate target, and again allows the quantity to fluctuate. So you can have an increase from $13 to $121 billion very quickly. And in fact, the increase that we had after the Lehman Brothers failure was from about 13, 15, 20 to $800 billion within a little bit of time. So, okay, so a lot of central banks do it this way, and the Fed does it this way now too, where in fact it's easier to hit the target if you have, again, a rate that they will pay interest and a rate that they will charge interest, and they just try to hit in between those two. Okay, the Fed wasn't doing that up until about 2008. They've done that since, although it's a little quirky the way they do things now. But at any rate, you see a number of central banks around the world running a system like this. Okay. If you add reserve requirements, you don't change anything except you flatten that demand curve at the quantity that banks are willing to hold, because now banks are willing to how do I say this? Now banks have about 2 weeks to meet their reserve requirements, so on any given day they're not as concerned about how much they're holding if they're not holding the exact right amount, because they can offset that at a later date. Although by the end of the 2-week maintenance period where they have to meet their reserve requirements, this quantity again, that flat region shrinks to zero again, virtually zero again. Okay, so there's not much difference. Okay, and it was pretty well recognized that the point of reserve requirements in the system was to make it easier for the Fed to hit the target. It's much easier to hit a flat demand curve than it is to hit a vertical demand curve. Okay, so here we have a couple of New York Fed economists that did an interesting paper a few years back. They say the cost of reserves, both intraday and overnight, are policy variables. Consequently, a market for reserves does not serve the traditional role of information aggregation and price discovery. It's a buffer stock. and they're setting a price. So let's see, I'm going to skip that one because I just went into that earlier. So implications, settlement balances, settle payments, right? We have this story in our Economics 101 textbook where reserve balances finance lending. Well, it doesn't finance lending. Loans create deposits, and then banks settle payments with the reserve balances. But the Fed sets the price of those reserve balances and lets the quantity float. So you can't have a money multiplier model because you have in the real world a buffer stock of reserve balances that's being supplied at the target rate. So since currency is also a buffer, or buffer stock number one, central bank generally can't control the monetary base because both of those can't directly control the monetary base. Okay? If you're going to have the money multiplier work, it's going to have to be indirectly where the Fed sets an interest rate, and that affects banks' lending and thus their demand for reserve balances. Okay, so again, I mentioned what had happened after Lehman Brothers. So the quantity, as I said, moved up to $800 billion rather quickly there because the Fed took a lot of the money markets onto its balance sheet. And so the quantity increased because there wasn't any way for it to drain that much. It didn't have enough. It didn't have enough assets on its balance sheet to be selling to drain those. And then we can see that the various rounds of quantitative easing pushed this up to 1.6 trillion. It might be larger than that now. So what does the Fed do there? Well, again, if it's a buffer stock, if you put out too much for the system beyond the demand curve, then what you do is you either go to zero or you hit the bottom rate that you've set. Okay, in this case, the remuneration rate or the rate that the Fed will pay on reserve balances. There's some quirks in the way the Fed does this that make the rate actually go a little bit below this. But the Fed has set this rate at 0.25. It's equal to its target rate now. And so you have a quantity of reserve balances now that's way out somewhere around RBA. Actually, it'd be somewhere in the other room over there if I was going to draw this to scale. Okay, so implications. So direct control over settlement balances is possible only with interest on reserves at the target rate or a 0% target rate. And in that case, you still have to supply more than banks need for settling payments. So excess balances without interest on reserve is not operationally possible, which is interesting because what we hear from neoclassical economists is that interest on reserves stops the excess balance story. Okay, that if you pay interest on reserves, then the reserves become perfect substitutes for Treasury bills and so forth. And so money and bills become perfect substitutes. So you don't have the excess money balance story of the monetarists where you get hyperinflation. But if you understand operationally how the buffer stock works, you understand that you can't have excess money balances without interest on reserves in the first place. Okay, number 3, Treasuries. So the quantity of Treasuries is not currently a buffer stock. The quantity of Treasuries, here I have prior to 2008, it was basically the national debt minus currency in circulation, because when banks would buy currency and then provide that to their customers, they would pay for that with reserve balances, and then the Fed would add the reserve balances back by buying a Treasury, because the reserve balances need to be in there to hit the buffer stock, the appropriate buffer stock, number 2. And then reserve requirements as well, which caused a drain in the Fed to buy Treasuries up to ensure there was enough reserve balances for banks to meet their reserve requirements. Okay, so again, prior to 2008, this was not a buffer stock. It's still not a buffer stock because, in fact, what the Fed's been doing is buying up more and more of these from quantitative easing. Okay, so in our financial system, Treasuries play a key role as collateral that enable a lot of lending to occur, a lot of refinancing to occur, and so forth. And let's see here, I don't think I did this, but if there aren't enough Treasuries available as collateral, you start to have some problems occurring in the money markets, which often called settlement fails. And so often they congregate around financial crises, but they don't have to. I didn't put the data up here for 2008, but it was over 500 billion a few times during that period. So that makes it difficult for you to have business as usual in the money markets. Okay, so This paper was by a couple of Federal Reserve of New York economists that were looking into the Treasury, which was itself looking into becoming, quote, a lender of last resort for Treasury securities to make sure there was enough collateral out there, which would essentially mean that the Treasury would be borrowing at a short-term interest rate and providing a just like in a repurchase agreement market. Another one, my friend Warren Mosler suggested a number of years ago that there were again some problems with counterparty risk and so forth in the financial system that could be fixed if you had a buffer stock basically of Treasury collateral out there in the system. Okay, let's see here. The other thing is that, switching gears a bit, because we have deposit insurance limits and because we don't have a buffer stock of Treasuries, one of the things that people would do is put their money into money market mutual funds, their short-term investments. We also know that this was one of the key things financing the rise of the shadow banking system. Okay, and that some of the issues with the rise of the shadow banking system, and I'm not going to suggest all of them by any means, might have been avoided if there had been a buffer stock of Treasuries. Okay, so here's an alternative approach. First off, and this one looks pretty messy, but bear with me. On the right-hand side, we have basically the public, and we also have dealers. And so on the top there, we have the public basically being able to, on demand, buy Treasuries. Okay, now they can do this to some degree already through Treasury Direct and so forth, but it's not done at the scale that we're talking about here. And then we could, on the bottom there, have the buffer stock of collateral as well that dealers then could get their hands on by basically lending at low rates to the Treasury. Okay, and so you could have that, and then if there were additional needs for the Treasury to issue debt because it's running a deficit that's still larger than the quantity that's being purchased in the buffer stock, then they could issue 3-month T-bills if we don't want to give the Treasury overdrafts, which politically that's a tough one. And if you gave Treasury overdrafts, you would just have what was left of the deficit causing excess balances. Okay, I'll talk about the implications here in a second. So the results would be unlimited risk-free investments at desired maturities, including overnight, for the public, and unlimited risk-free collateral at desired maturities at a small penalty rate compared to the market rate. Implications. So we'd have a true buffer stock of risk-free securities that was consistent with the needs of the private sector. But here's one of the really significant points. It'd be obvious that the interest rate on the national debt is a policy variable, right? We hear all the time about the bond vigilantes, the U.S. can become Greece, et cetera, et cetera. Some people are starting to figure out that that can't happen. I've been writing about that for about 10 years, explaining why that couldn't happen. But it would be obvious now that interest rate on the national debt's a policy variable, because providing a buffer stock of Treasuries, you would simply set the price and allow the quantity to flow once again. Separates Fed's operations for payments from the buffer of securities, whereas right now they're interlinked, and that's one of the reasons why we don't have a buffer stock of Treasuries. Okay, number 4, net financial assets. So Tim talked about this a bit. The current mainstream view is for monetary policy to manage the economy through the interest rate. We're apparently told that the interest rate, the federal funds rate, basically the short-term interest rate, can control everything and expectations. Fiscal policy gets out of the way, balances its budget, at least over the longer run, balances its budget. Okay, so some of us like to take a bit different perspective on what fiscal policy should be doing. And what we do is we talk about how financial flows in the economy are a closed system. Okay, that one person's deficit is somebody else's surplus necessarily. So if the government's running a deficit, we think of that as bad, but we forget to recognize that somebody else has a surplus. Okay, particularly at a time like this, as Tim said, when you've got a private sector that's attempting to deleverage. Okay, so we have to recognize that the balances of these sectors, because it's a closed system, have to sum to zero. Okay, and if I rearrange that equation a little bit, I have a private sector balance, which is basically the net saving of the entire sector. It's not the same thing as saving. We have to be careful and not try and equate it with saving, or the traditional measure of saving. It's net saving, so it's the spending relative to income for the sector. Okay, so it's largely a measure of financial fragility or stability in the private sector, rather than a measure of saving and capital accumulation, which is what we normally think of with saving. So those are important as well, but we're focusing here on the financial fragility issue. Okay, so we could take the government deficit minus the capital account there. Okay. And so if we wanted to graph what's going on here, this is the one that if you've followed our work at all, you've seen this one millions of times. But the change in buffer of net financial assets, again, is basically the federal government's deficit, because the federal government, when it runs a deficit, somebody else ends up holding the Treasury, and that's an asset. And it's a net financial asset because there's no liability anywhere in the private sector. There's only an asset as a result of the government deficit. Okay, the government ends up being the one with the liability. So the significance here is this quantity is changing. Okay, you can see it changing from year to year. And it moves very closely with the private sector balance there. Okay, that's the main thing it's moving with. Mirror image, of course. So the private sector wants to net save more. The government runs a bigger deficit. As it turns out, those spikes where this widens tend to be recessions, right? That is the recession. The private sector decides to save more of its income instead of spend it. That is the recession. Okay, and then the government sector, frequently automatic stabilizers, right? Tax revenues fall and so forth, runs a bigger deficit. It could be a more activist approach with government stimulus. So either one of those would show up here. So one of the significant things is you can look at there and you can see that the private sector, on average, likes to run virtually permanent private sector surpluses. Okay. The two times that it didn't were the stock market bubble in the late 90s and the housing bubble in the 2000s. Okay, and then people like Dean recognized those problems going on. From this analysis, we saw this coming on as well. That something was very wrong there. Oops. Something was very wrong there if the private sector all of a sudden was happy net dissaving. Okay, because that's completely at odds with their historical behavior. And so that led us to believe there was some financial fragility increasing in the private sector. Okay, so let's look a little bit at what fiscal policy does and look at how this understanding of net financial assets helps us understand fiscal policy and monetary policy. So fiscal policy, when we run a government deficit, basically what we end up with is the household sector ends up with a net asset. Well, in this case, I'm thinking of government spending, but you could do it with tax cuts and so forth. But let's assume it's government spending, sending a check to the household sector. So the household sector would get net deposits there, and that is an increase in net financial assets because they have a deposit, but it raised their capital, it raised their equity. Okay, there's nobody there holding the liability. If we require the Treasury to issue securities in exchange, then it looks like this, but this is not a change in net financial assets. This is an asset swap, where the dealers, which is represented by those guys up there in the top right, buy the Treasury security. So each one of those has something coming to it and going away from it. So there's no net increase in the position for anybody in that sector. So when I guess I was supposed to do this. I'm going to skip that one. So when we have a Treasury sale, there's no change in financial assets. And from two, there's no change in the ability to create credit and deposits because reserves are a buffer. Okay, so we like to think, we're told to think that when the Treasury issue securities instead of, quote, printing money. It will be less stimulative to the economy. But when they issue a Treasury, actually, and they drain, when they issue a Treasury, the banks still have as much ability to create loans as they did before, even if you're draining the reserves. And from buffer stock 3, the Treasury collateral actually ends up financing more credit in the financial system. It doesn't slow anything down. There has never been anybody who is unable to spend because they're holding a Treasury. Okay. In fact, we have 20 plus dealers out there that are willing to buy that Treasury from you at any moment. Okay, so the point I was going to make here between these two was that there's not much difference if we give the Treasury an overdraft and pay interest on reserves, or the Treasury sells the security when it runs a deficit. The most important thing here is that it's increasing the net financial position of the private sector, as I've got there. Okay, when we look at fiscal policy, there's a couple of things. First off, we affect the price of credit, which ends up, if we do it right, we end up with more credit creation to try and stimulate the economy. Okay, and as Dean pointed out, that can create, that can be very useful in the sense if you have refinancings and so forth. But what you're attempting to do, and we don't often think about this, is something very different from fiscal policy with monetary policy. With fiscal policy, you are attempting to get the private sector to spend more out of an increase in income. With monetary policy, you are attempting to get the private sector to spend more out of existing income. Okay, and we don't talk about that because, in fact, we confuse the terms money and income. And so when the Fed creates money by doing what I have there on the bottom, which is buying a Treasury or mortgage-backed security and raising reserve balances and deposits, then we think that that has added jet fuel to the economy the same way if it was income. But it's an asset swap, right? And the dealer had every ability to expand its own balance sheet before it got the deposits. Okay, so fiscal policy creates, and this is the distinction I would make between fiscal and monetary policy. It creates and destroys net financial assets through its deficits and surpluses. If you're trying to stimulate the economy with fiscal policy, you're trying to create more spending out of more income. Monetary policy does not change net financial assets. What it attempts to do is create more spending out of existing income, either by reducing interest rates or pushing everybody into lower yielding deposits from their treasuries or from their mortgage-backed securities. Okay, or by doing QE to try and reduce interest rates, which is doing both of them. Okay, so we like to talk about something, and you have to be careful with this because this is not intended to be an actual equation, but for those of you that took Economics 101 and you learned MV equals PY, where it's the money supply times the velocity or the turnover of money equals nominal GDP, quantity theory of money, we like to talk about the quantity theory of net financial assets, which is basically, as Warren Moser likes to say, the monetarists are right, they just have the wrong money. So the money we like to talk about is the net financial assets that are accruing to the private sector, and again, in a buffer stock manner because the private sector wants more or less of them based on the state of the economy. But they tend to want a positive amount of them, increasing amount of them each year. And then the velocity would be some function of desired private spending out of private sector income. And so when we think of monetary policy, it's attempting to increase V, and fiscal policy is attempting to increase M. Okay. And that's, for us, a useful way to distinguish between what fiscal and monetary policies are doing. Okay, so what are some implications here? Okay, so what does excess money mean? Excess money here would mean, and we're talking about excess money from the traditional monetarist perspective, where you have too much money chasing too few goods and you get inflation. It would mean a buffer of net financial assets that's too large given desired private spending relative to income. Okay, so the government's deficit then would be too large relative to what the private sector wants to do. Okay. But what we noted before was that the quantity of net financial assets, or the growth in net financial assets, tends to be positive, that there's a desire to have about 2% government deficit on average, 2 or 3% government deficit on average, all the time, although it's a fluctuating amount. And this is different from the way that we think of fiscal policy in our traditional new consensus model, which is, again, fiscal policy, get out of the way. But what if, in fact, we need net financial assets as a buffer stock for sustainable private sector spending relative to income over the longer term? So it implies net financial assets as a buffer, and that should become part of the monetary policy reaction function, which is, again, different from the received view, which is that fiscal policy get out of the way and let monetary policy be independent. Okay. Given net financial assets buffer in the reaction function, debt service as a policy variable must also be in the reaction function. Okay, what am I talking about there? Well, if the government's going to run permanent deficits and a fluctuating amount, but generally permanent deficits, to enable the private sector to net save, then you're going to have the issue of government debt service. Okay, and that's going to be affected. That turned out rather sloppy, but that's going to be affected by the debt service is going to be affected by the interest rate that the central bank is setting in its monetary policy reaction function, and so you have some potentially perverse effects. If you look down low there, if you have a government with a high debt to GDP ratio, and you start to increase interest rates to slow the economy down, you're going to get more government spending on debt service. Okay, and so you could speed up the economy when you wanted to slow it down. And so this has some significant implications. And we're running into that now, and Japan is running into that, which is the deficits that have been run to provide to offset the private sector's desire to save the last 4 or 5 years and the last 20 years in Japan have led to large increases in national debts. And so at some point, raising interest rates, the central bank raising interest rates, is going to come up against the fact that this could, in fact, create an increase in government spending that might offset the slowing down effect that you would expect from raising interest rates in the private sector. Okay, so it's going to require a coordination of some sort between fiscal and monetary policy that recognizes this permanent need for a buffer stock of net financial assets. Okay, the last one, labor. And here's where Tim and I have a significant convergence, I think. So your traditional Economics 101 textbook is your traditional production possibilities curve shows that unemployment means you're at a point like D, where you are not where you're wasting scarce resources and the economy's not producing up to its full potential. There's other things going on there. I thought this was kind of interesting that the cost to taxpayers of each unemployed person is rising significantly. It's also rising in the U.S. as well. And beyond economic costs, we have well-documented social costs. Virtually every social problem out there has a statistically significant correlation with involuntary unemployment. And this was an interesting graph somebody put out, which shows how unemployment rates and male suicide in Japan move very closely together. Okay. So interestingly, we have all these costs from unemployment, but we have a policy, and this is from the Fed in 1999, but it's still the general view, where they're saying, let's see, I'm going to start the sentence above that. Despite tentative evidence of a slowing in certain interest-sensitive sectors of the economy, accelerating productivity, the expansion of activity continues in excess of the economy's growth potential. As a consequence, the pool of available workers willing to take jobs has been drawn down further in recent months. This is a trend that must eventually be contained if inflationary imbalances are to remain in check and economic expansion continue. So we have a policy view to keep a certain amount of people unemployed, millions of people unemployed. That's a policy goal, actually, right? And the intent is to keep inflation in check, right? That we keep a buffer stock of unemployed of 10 million, 15 million people, whatever, in order to stabilize inflation. Okay, so interesting when we have these debates about Should we spend on unemployment benefits and so forth, and why can't all these people get jobs? When at the same time there is a distinct policy goal of keeping 10 to 15 to 20 million people unemployed at all times. Okay, and the Fed actually said that. So we don't generally think of labor as a buffer stock, but if we did, we might recognize that we have two choices. We have the choice of an unemployed buffer stock, which is what we generally do, or an employed buffer stock. Okay, and so since there's only two choices, you have to be in favor of one or the other. And being pretending that you just don't like the employed buffer stock means that you're in favor of the unemployed buffer stock and all the social and economic costs that come with it. Okay, so again, Tim was talking about employment programs and so forth. This is one that some of my colleagues in modern money theory have come up with. Most everybody that has followed us has seen this many times. But basically the idea is for a government to offer a job at a fixed wage, some fixed wage set politically. And the point of the fixed wage is, again, it's a buffer stock, and so you don't want market forces to drive the price up or down because that would be more stabilizing to prices. And the argument's going to be that this would be at least as good at stabilizing prices as an unemployed buffer stock. Okay. I simulated this in a 1500 equation model of the economy, and I don't pretend that this is the definitive word on what would happen with what we call a job guarantee program. It was more to get at the logic of how the program would work. It's a buffer stock, so it should be coming down in an expansion and rising during a recession. Okay, so that was what we were attempting to show there. But the interesting point of this is the cost of the program, and I just assumed that a quantity of people equal to the number of unemployed would be in the program. Okay, it doesn't mean that they're the same people, but I wanted a buffer stock that worked just to see how that would work. Okay, and so we end up with maximum spending, at least in my simulations, about 1.4% of GDP. On average, the program cost, the black horizontal line, about 0.95% of GDP was the average. So it's not a overly large program in terms of spending as a percentage of GDP. But if you do that, what you get is some stabilizing effect on prices. Not hugely stabilizing, but the program is not inflationary. The program has some permanent increase in the price level, and so a temporary increase in inflation when you start it up. But then as the economy expands and you get later in the expansion, when the economy normally would be building up inflationary pressures, this program is reducing inflationary pressures in the economy. Very modestly, but doing it nonetheless. So again, this is just a little bit on the logic of the program. It's not a jobs program in the sense of to just create jobs. It's a jobs program to become a buffer stock that will replace the unemployed buffer stock, okay, or at least offer a different option to people. What's the opportunity cost of an employed buffer stock of labor? So this is really something that is difficult for people to swallow politically, is that the government's going to employ millions and millions of people and so forth. A lot of people don't like that. But if you don't like that, what you're saying implicitly is that you do like all of the social costs of unemployment. You do like all the unemployment benefits that we have to pay. You like all the crime that we have to pay to prevent, and the prisons that we have to pay to build, and the additional Medicaid spending we need, and that your health insurance rates go up, and that state and local government budgets worsen during a recession because of, or the state and local government budgets worsen when the unemployed buffer stock increases. Okay, so if you don't like an employed buffer stock of labor, then what you're saying is that those things don't bother you as much as the government offering to employ people and create a buffer stock of employed labor. The other thing we hear often, and this comes from economists quite a bit, is, well, the workers won't be very productive. Okay, but they kind of miss the point, which is they're comparing the productivity of people in these programs to people who are working in the private sector, when the real comparison is actually how productive the involuntarily unemployed are, because that's the opportunity cost. right? That's what you get. You get an unemployed buffer stock of labor if you don't have an employed buffer stock of labor. Okay. All right. A lot more could be said on that, and we'll probably get some questions on that maybe because Tim and I were both talking in different ways about this. Again, a good deal of literature on that from a number of us, so going a bit quickly through that right now. So at any rate, just to conclude and wrap up, so 5 buffer stocks for macroeconomic policy. So the first 2 we already have, a currency buffer and settlement balances buffer. We just don't often understand that we have them. And so we have a lot of economists misdiagnosing what's going wrong and making suggestions for things that are frequently inconsistent with actual operations. A Treasury lending facility that would both make Treasuries into a buffer stock, but would also make it clear that interest rates on the national debt are policy variable, which they already are for all intents and purposes, but now it would be obvious and we wouldn't be able to get away with saying things like the U.S. can become Greece. A sustainable, not excessive quantity of net financial assets that fluctuates with the business cycle. This would require some interaction now of fiscal and monetary policies. And an employed buffer stock of labor. Announce fixed wage to replace the unemployed buffer stock. Okay, I'm done. Thank you.
Hi, welcome back. So what did you think? Put the comments below. Let us know how you came to us. Let us know how you found us. What do you think? What do you think about what you just saw? You know, when Scott Fullwiler talks about the difference between a buffer stock of unemployed people versus a buffer stock of employed people, my personal takeaway, the federal government is spending anyway. You know, if we are going to set up an economy that necessitates a certain number of people being unemployed by design, the federal government is still spending. It is spending on unemployment insurance. It is spending on job retraining for jobs that don't exist. You know, we have all the consequences of unemployment, the social ills, the crime, the drug use, you know, domestic abuse, and all this requires monetary intervention in the form of prisons and healthcare, you name it. We're still spending, but we're spending on the ramifications of misery that results from unemployment, involuntary unemployment. Instead, we could be spending less and get more. We could be spending for a federal job guarantee and have a buffer stock of employed people and drastically reduce, if not outright eliminate, the social ills, at least as it pertains to involuntary unemployment. We will never get rid of social ills completely. There are many reasons why they exist. But involuntary unemployment, economic desperation throws gasoline on all of it and then lights it on fire. There's so much we could be doing, and we're not because of the rampant misunderstandings of how the economy works. Welcome to why we're here. Welcome to MMT Mondays. Thank you for joining us. We'll see you next week.